Good Tuesday afternoon, everybody. Historic bounce on Wall Street that everybody on financial TV is going cuckoo for Cocoa Puffs over, which you might expect I'm not super excited about. Why? It's a bear market bounce. Remember, you do not get 10, 11, 12% bounces in bull markets. That's not indicative of a healthy market. So sometimes people will ask me, why do you think it's not healthy? Why do you think that we've not seen the bottom yet? And some of that is, to this point, the economic damage that is being done by a global shutdown due to a virus is literally beyond what almost all economists are anticipating or expecting. The news cycle will continue to give us spurts of hope and happiness, and then, of course, spurts of negativity. The whole medical thing is way past my pay grade, so I can't comment on that other than to suggest that I've had some conversations with some really smart people, many of whom are in the medical profession and have been for 20, 30 years. And some of them have never seen other medical professionals as nervous and just straight up scared as what they're seeing right now. And my point to that is that changes behavior. So we're witnessing in real time a change in both personal and corporate behaviors that, quite frankly, no one knows how it's going to play out. Economically speaking, we know this. We know that the economy was starting to slow in Q3 of 2018. And so the data has been showing a slowdown for some time, and if you looked at it on a sine curve, kind of like an S-based sine curve, and we kind of were over the top portion of that hump, that sine curve in Q3 2018, and then started in the downdraft. The only thing that this virus has done is accelerate that downdraft, which may be good or bad. So what do we have now? We have a circumstance where the government, just like in September of 2018, we're negotiating all sorts of potential bailouts and giveaways, and who knows what you would want to call it. All I know is this, is that back then, September 18th, September 29th, 2008, was a time where both houses, Congress, the House and the Senate, were arguing, and one of the bills failed, and what did we get? We got a stock market that rallied for a few days. The Senate then passed a bill, and the market just completely threw up, fell apart, right? What are we witnessing right now? We witnessed a very strong bump to the upside today that, quite frankly, I think was an opportunity to use to either sell into, if anyone were still long equities, or possibly to short some positions for those who are more aggressive. Tomorrow probably will be another opportunity to place on a few shorts if necessary. So we're looking at that. However, with volatility, the volatility regime, the VIX, which identifies volatility in the equity market, the MOVE index, which identifies volatility in treasuries, OIV, which identifies volatility in oil, GVZ, which controls volatility of gold, all of them are very high. And the point of that is that when volatility is super high, it makes for a very uninvestable market. It makes for a tradable market, and a very good one at that, but investments are something that you have to be very careful with. So therefore, we are not interested in taking positions in equities at this point. In fact, we're taking a continued very bearish stance on the entire equity market, and I do not believe that we have seen the bottom yet. Sometimes that comes down to sentiment, or a lot of it rather. And if you have conversations with an average non-professional investor, the conversation right now is going somewhere along the lines of, oh man, the market's just collapsed so much. What a bunch of great buys. We should be buying airlines and energy and Ford and all those good things. That's not the conversation a non-professional average investor has at a bear market bottom. The bear market bottoms are signified by that kind of an investor unwilling to open their statements because they're terrified at how much money they lost, kind of in the corner in a fetal position, throwing up at the thought of how much money they lost. Bear market bottoms happen when nobody cares about the market. And just do your own little survey. Have a conversation with an average person that is an investor. And I think you'll walk away from that conversation saying, yep, they're pretty bullish. So at any rate, after having been doing this a fairly long time, you get the sense as to how markets are structured just simply by how people around you might be acting. Not to mention that we're in the face of this very serious and very odd and very new type of an environment due to the coronavirus, which nobody seems to have an answer to in terms of how long it might last. So therefore, the only three things that we're doing and considering right now are positions in the dollar. The U.S. dollar index continues to be extremely strong. The world is very short of dollars. And so therefore, we anticipate a strong accumulation of the dollar. And so we, for most of our portfolios, would consider a full position in currencies somewhere to the tune of 10 to 12%. We started today with a quarter of that position. It's something that we plan on easing into over a short period of time, dependent upon price movements. And so I'll share my screen with you real quick. We use an exchange-traded fund symbol UUP. And so we bought that position right about here today. And we would anticipate that any other minor pullbacks that we get, you can tell it doesn't move real fast, right? So it'll give us some opportunity to continue to enter in until we get a full position in that. It's hard to say how long that'll take, but we're going to be extremely patient. We're only going to make choices and decisions based on the math and the reality of what's happening. Not what goes on TV, not what goes on with talking heads, not what goes on with people's emotion, none of that. It's all about the math. And right now the math says that dollars are short, in very, very short supply in the world, and everybody wants them. So we figured it's time to start accumulating them, and that's what we're doing on that end. The next thing that we're looking at is another position in treasuries. And the treasury position will only happen once we ultimately see interest rates spike back up. So interestingly enough, you had a situation where the Fed comes with the mother of all bazookas and throws the entire kitchen sink with quantitative easing infinity, which simply means that they're going to do whatever they can to backstop ultimate and massive liquidity into the system. They have started buying investment-grade corporate bonds, which they've had to go around the Federal Reserve Act to do. And the way that they did that was set up something called an SPV, or Special Purpose Vehicle. Hard to say how that whole thing comes out, but at the end of the day, investment-grade corporates had a bounce, and it's likely that investment-grade corporates are going to fall apart again. So we're staying away from investment-grade corporate bonds. We're staying away from muni bonds. The only thing that I would even venture into taking into another position like we have over the past this month is in longer-term treasuries. And that's only going to happen if interest rates get back up to about 1.25%. Right now, today, they closed down in the 0.83 or so percentage range, and what we want to see them get into is this 1.25% range, or somewhere in that neck of the woods. And we think that this interest rate, just like it did in September of 2008, will do the same thing. This is a quick picture of the E-mini 500s. It's the S&P 500 E-mini futures. And back in September 28th, 2008, you can see what happened. Same kind of scenario. Congress is messing around, doesn't know what they're doing, miss a bailout bill, don't pass it, whatever. Market continues to accelerate over a few days. The Senate passes the bill, and market then does what we call throw up on itself. During that same period of time, September into October, long-term interest rates accelerated. And we ended up seeing 4% on the 10-year Treasury in a fairly short period of time, which was a pretty big move back then from the mid-threes. So it would not be surprising for us to see 1.25% on the 10-year Treasury here over the next several days. If that happens, then we'll start to get a position into Treasuries as well, just like we did before. We took a position in 10-year Treasuries up in this neck of the woods and sold them down in this neck of the woods. Again, this is the yield, so you want to buy when the yield is high and sell then when the yield is low. What we bought that represents the 10-year Treasury is this. Sorry about that. Is this. So We anticipate this to keep coming down, and then we'll buy it and then ride it for a higher run. So treasuries are the other thing that we're looking at besides accumulating a dollar position. And the last thing that we're looking at accumulating is gold. Gold today spiked very, very high, as represented by the ETF GLD. And so you can see here it's closing in the lower half of their trading range. And the answer to that in terms of, well, why did it start to close in the lower half of its trading range, is that that position based on spot gold price ended up hitting a level where we would naturally anticipate shorts to start coming in and putting some pressure on the sell side of that. So what we anticipate is gold on the spot price to come back down somewhere into the 1420 to 1450 range. If it does drop down into there, then we'll start a gold position. And for most portfolios, it would not exceed 10 to 12% of the account. But with the federal government essentially making their money printers go brrr really fast, I would expect gold to do pretty well over time. But we'll see. Again, this is all about patience. This is all about the math. This is not about emotion. This is simply doing what the math tells us to do. And right now the math is telling us that if gold gets to that 450 range, maybe even 1500 range, we start legging in. We start putting a position together in that metal. So that's it. Dollar, treasury bonds, gold. Nothing to do with oil or equities. Oil. Some people have asked me, man, oil is so low. Don't we want to do that? No, and here's why. I'm going to show you a quick picture. So this is a picture of symbol oil. Represents crude oil in the overall market. Obviously, it's gotten slammed really badly. But what I really want to show you is the oil volatility index. Now look at this. For the most part, oil volatility lives down here, right? Somewhere in this average of 20 to 30. So recently, it's been up here. Today it's at 166. 5 days ago, it hit a high of 423. Always have to remember that money moves from high volatility asset classes to low volatility asset classes. Oil is not a low volatility asset class, nor will it be anytime soon. As we continue to see gold go through its regiments of high volatility to low volatility, then that's when we would want to consider a trade in gold. The Federal Reserve is doing everything that they know how to do in an attempt to tone down treasury bond volatility. And so there's an index that tracks treasury bond volatility. It's called the MOVE index. And when the MOVE moves out, treasury bond volatility gets very, very, very high. And it creates an opportunity for not only an investment in treasuries, but also a trade within treasuries. As that MOVE index slows back down, it allows for us to be a longer term holder. Right now, that MOVE index has moved out and is starting to stabilize, which is indicative of what the Fed is doing. And we have to remember, back in the financial crisis, the Federal Reserve was buying roughly $75 billion a week in treasuries. Right now, they're buying $75 billion a day, in addition to $50 billion a day of mortgage-backed securities. The bond market is under a lot of stress, and you can tell by something called interest rate spreads and a bunch of other complicated gobbledygook. Just know that when interest rate spreads get really, really, really wide, in other words, treasuries are paying a little and high yield is paying a lot, there's a lot of stress, right? So whenever there's stresses in the interest rate market or the spreads, that's a problem, and the Fed knows it, and so they're doing everything they can to try and minimize that or get a hold of it. So that's what we're doing. We're just being patient. We are almost all in cash. Again, we considered a 2.5% to 3% starting position today in the US dollar, and that's it. We won't even consider a position in treasuries or gold until we see treasuries with the 10-year yield get up to that 1.25 range, and wouldn't consider gold unless we see it drop back down on the spot price in that 1450, maybe 1500 level. So patience is the key. Patience is the word. I hope all of you are doing well and that you're safe and comfortable and not finding this virus, sickness, or anything anywhere near you or your family. Selfishly, I enjoy having my boys home, both together at the same time. Certainly you'd like it under different circumstances, but you know, hey, I'll take it. I appreciate our family being together. So hopefully you guys are together with your families and able to enjoy the feeling of post-apocalyptic lockdown. If there's anything I can do for you, let me know. Direct number 608-354-1977. Email chris@careformywealth.com. There's no such thing as a silly question right now. I mean, these are unprecedented times. The times that we're up against and the kinds of things that we're seeing come at us with this virus are just unprecedented. I mean, nobody knows what to anticipate or expect. But as a man of faith, I'm going to do my best to not fear. There are lots of instances in Scripture where we are told very clearly, don't fear. So best I could do to share with you is maybe take a moment and find some scripture points that help you to identify what it means to not feel fear. So don't feel fear with regards to your money. We're going to continue to do our best. Know that we're positive on the year. We're going to continue to work towards that, keeping things fairly short term and very, very much under control with risk and the control of risk at the very, very forefront of everything that we're doing. So thank you again for your time. Thank you so much for the continued opportunity to work for you. Please reach out if you have any questions on anything at all. Thanks. God bless. Have a great day.